When a highly anticipated tech giant hits the public market, retail investors often rush to buy every early dip. They assume they are securing a ground floor position, but the price action following these hyped listings often follows a structural pattern that favors institutional liquidity over retail profit. By the end of this video, we are going to build a mechanical, math-driven dynamic dollar cost averaging system to counter the specific mechanics Wall Street uses to exploit that enthusiasm. To follow along, you will need a blank spreadsheet or notebook, capital ready for a long-term horizon, and basic knowledge of market capitalization. This system is designed to remove the fear of missing out from your decision-making process. We are going to turn price volatility into a calculated long-term advantage. To understand these mechanics, we can use the hypothetical model of a space IPO, the most anticipated listing of this era. This case study lets us track how a stock moves from its initial offering price to an artificial peak in just a few trading days. Before buying any new listing, your first step is to research two specific metrics: the percentage of the public float, the shares actually available to trade, and the mandatory index inclusion dates. Large institutional funds often engage in pre-positioning. When a mega-cap stock is fast-tracked into an index, funds are required to buy billions of dollars of shares. To avoid paying a premium on the official inclusion date, they buy early, forcing a massive volume of capital into a narrow public float. This forced mechanical buying pushes the price line shooting upward in a matter of days. This rally is driven by institutional positioning, not fundamental value. This leads to Rule 1 of your system: strictly prohibit any buying during the 15-day mandatory index inclusion window. Chasing these early rallies means you are likely buying at a precarious peak, completely engineered by Wall Street's institutional mechanics. By waiting, you allow this artificial liquidity cycle to complete before deploying your capital. For the second step, find the company's listing date and mark exactly 6 months later on your calendar as a high-risk zone. An initial public offering is a liquidity event. It is designed to allow early investors, directors, and employees to cash out their positions. Most hyped listings follow this curve: an early spike, followed by a steep correction around month 6 when frozen insider shares flood the market. This is a repeatable pattern. Look at the historical data for Palantir. It experienced the identical spike, the lockup crash, and a long flat line before recovery. Rule 2 for your system is to mathematically expect a correction of roughly 50% near the 6th month of trading. By mapping this timeline, you can view the month 6 flush as a predictable mechanical event. This prevents panic selling and keeps you focused on the long-term business case. Now, write down the company's current valuation multiples side by side with the current risk-free interest rate. You must separate the business into its core components to understand its true value. In the SpaceX model, a highly profitable connectivity business like Starlink must be weighed against high-cost R&D sectors not yet generating a profit. Compare a company trading at 90 times its revenue against the guaranteed yield of government bonds. When the Treasury hands you a risk-free return of 4%, the hurdle for holding a speculative tech stock becomes significantly higher. Establish a hard rule: if the underlying business metrics do not justify holding the stock for 10 years, in a high-interest rate environment, you immediately abandon the trade. Every dollar you put into a loss-generating company is a dollar that isn't earning a guaranteed return elsewhere. In this environment, cash is a weapon that requires a high potential reward to be deployed. Now we will build the spreadsheet that automates your buying behavior and removes the influence of market hype. In column A, track the stock's highest price point over the trailing 52 weeks. This provides a constant anchor for the current market peak. Column B is your action threshold. You multiply the 52-week high by 0.80. This level represents a 20% drop from the top. If the current price is above that threshold, you are in the red zone. You are only permitted to buy a standard 1x base allocation to keep your position size small during periods of high valuation. When the price falls below the line, you enter the green zone. Here, you execute a 3x aggressive allocation to capitalize on the lower prices. This math forces you to accumulate slowly during peak hype, while aggressively lowering your average cost when the rest of the market is in a panic. This system effectively neutralizes the volatility of new listings, turning unpredictable price swings into a systematic engine for wealth accumulation. Your dynamic DCA system is now constructed and ready for deployment. You are now insulated from institutional front-running, you are prepared for lockup crashes, and you have a mathematical rule set that dictates exactly how to deploy your capital. Your next step is to plug a target listing into this spreadsheet and conduct the fundamental research to see if the business is worth a 10-year commitment. Success in the market comes from trusting math over emotion. By sticking to these mechanical rules, you utilize a systematic framework to navigate the same market environment that traps most retail investors.